I can't hear anything.
I can't hear anything either.
Okay, now I can hear Baker,
I can't.
but
The sound is gone.
Wait, what's going on?
Professor Lori, are you on mute? She's on mute.
Hey, Professor Dunn, you're on mute.
She put everybody on mute to do the problems.
Can you hear me now?
yeah.
Yes.
I don't know. My microphone got jazzed up. I had to reset my microphone. Now are we good?
We're
Yes.
good.
All right. So what do you think about the first journal entry? November 25th. What will it be?
Debt investment
Debt investment. Uh-huh.
and then cash for 50,000.
You got it. So we'll debit the debt investment for the cost of 50,000 and credit cash. Excellent. All right. What about December 31st when we find out the securities have increased in value, or I'm sorry, decreased in value to 47,000? Journal entry?
You're going to debit unrealized loss, AFS, pardon me, and fair value, and then credit fair value adjustment.
For how much?
For 3,000.
3,000, right. So we debit our unrealized loss equity. So we know that that unrealized loss gets reported in the equity section. And we credit the fair value adjustment account because we need to decrease the debt investment by $3,000. Good. Questions on those so far? All right. Now on April 6th of the next year, Jorn sells 10% of these securities. So 5,000 was the original cost for $6,000 cash. So what would be the journal entry to record that?
You said a cash for 6,000
Mm-hmm.
and then debt investment 5,000.
Credit it?
Yeah, credit and then loss credit 1,000.
Actually, that's gain.
Oh, gain. Yeah, sorry. Yes, again.
Yeah, gain on sale for 1,000. Good job. Yep. So we sold it for 6, originally bought it for 5. So we're only going to take out the part that we're selling. So $5,000. And then since we sold it for more, we have a gain on sale. Good.
I was kind of confused because they're talking about 10%, and I was like, do we really need the 10%? No. We have
No, it's just the percentage. They didn't sell the entire debt investment they purchased, just that one little part. So they still own the other 90% or 45,000.
Yeah.
Okay, great. So that is our debt investment, the different categories, and the special accounting we do when a debt investment is in a particular category. It's either going to be the trading category, the other extreme held to maturity, or what we just looked at, the category in between available for sale. So now we could start talking about equity investments. Now, equity investments are when the investor purchases the stock of another company. So now the investor is an owner of the company that they purchase the stock from. Just like when you and I would buy stock, we're considered an owner. Companies buy the stock of other companies. Now, when we talk about these types of investments, we really focus on the investor buying the common stock of the other company or the stock that gets a vote, the voting stock. So that's what we're focused on here. We're assuming the company, the investor, us, in this chapter are purchasing the voting types of stock. Now, just like debt investments are put in certain categories, so are equity investments. But equity investments are put in a category based on the percentage of ownership. So it's not the intent of the company, but it's really the percentage of ownership, and even more so, how much they can influence the other company. And that's usually our first thing is, can this investor influence the other company? And it's usually determined by how much you own of the company. So generally, companies, so if the investor owns between 0 to 20% of the voting stock, we call this the insignificant influence category. So that's one category, that's one extreme. So if you only own between 0 to 20% of the voting stock of the other company, you're not considered to have a significant influence on decisions or how it operates. The next category is for the investor owns more than 20% up to 50% of the voting stock. In this category is called significant influence category. And there's special type of accounting we do for the investment in this category. And we'll probably get to that more on Friday. The last category is the investor owns more than 50% of the voting stock. Now you have control. And we do a special kind of accounting when you are in control. If you own more than 50% of the voting stock, you make all the decisions because you own a majority of the votes. Now we're going to show you the journal entries related to the first two categories between today and Friday. The last category, I actually just got finished teaching it in an advanced accounting course, which is a junior in college level accounting major course. So we're not going to show you any specific journal entries. There's 5 chapters actually we did on that type of investment, what companies have to do. So we're not getting into the nitty-gritty of that category. We're just going to talk about it and give you some special things that happen when you own more than 50% of the voting stock of a company. Okay? So this isn't subjective. This is, do you have insignificant influence or do you have significant influence? So let's take a look at this first category, the insignificant influence category, and what kind of journal entries would commonly occur. Notice, we're not saying, oh, how long are we going to own the stock, okay, to determine the category. It doesn't matter. What matters is how much influence you have over the company's decision making. So let's do an example. Let's say today, for 1 of 20, company A purchases 1,000 shares of IBM for $50 per share, cash. And this represents 1% ownership. So they're just like an investor who's fooling around in the stock market, trying to make some money. That's basically how we look at a less than 20% owner. You're not in it to influence the decisions of the company. You're just trying to make some gains and losses on your, or gains, hopefully, on your investments. You don't have a reason for owning that company beyond being a normal investor. So on 4/1 of 20, Company A will debit, make sure I use their, it's probably equity investment. But sorry, I should have looked at this.
Investments, I think they use.
Is that what they use?
Yes.
Okay. Yes, stock investments. Yeah. Stock investment. And you could, indicate something here that it's not significant influence if you wanted to, but you just need to debit stock investments for $50,000, the amount it's cost, and credit cash. So you're going to debit an asset account for your investment, and you describe it stock investment, and then credit cash. Any questions on that? All right. Now, when you owned a debt investment, you usually received interest over the life of the debt. But what if you own a stock investment? Well, you may receive a dividend. You may not. But let's say this company received on 7/1 of 20, Company A receives, a $600 dividend from IBM. And that's a cash dividend, $600 cash dividend from IBM. Well, all Company A does when you have insignificant influence, you debit cash for the amount of the dividend. You definitely got $600 cash, but you credit dividend revenue. So you credit dividend revenue whenever you receive a dividend in this method, in this category. It's going to be a little different if you have significant influence when you receive a dividend, okay? But we just record the investment at what we paid for it. When we receive a dividend, we just record it as dividend revenue. Dividend revenue, like interest revenue, is reported in the other revenue and expense area of our income statement. Okay, so it increases net income just like any other revenue. Questions? Okay. Now, insignificant influence category of stock investments must be reported at fair market value on the balance sheet date. So on 12/31 of 20, when you do a balance sheet, must report this investment, at its fair market value, just like we did for trading debt investment and we did for available for sale debt investment. And we're going to have a similar journal entry. And the unrealized gain or loss is treated just like we did the unrealized gain or loss for a trading debt investment. It's reported on the income statement. So let's see how this drives out. So on 12/31 of 20, IBM's stock is trading at $55 per share. Well, Company A is going to go fair market value of IBM stock will now be the 1,000 shares times $55 a share, 55,000. Right now, the stock investment account only has $50,000 in it, the cost. So this stock investment increased in value by $5,000. So there is an, sorry about that line, unrealized gain, and this will be NI for net income, the income statement, $5,000. So the NI stands for net income, meaning this unrealized gain will be one of those reported directly on the income statement, just like unrealized gain or loss on our trading debt investment is reported directly on the income statement. So on December 31st, the company will debit a fair market value, or I'm sorry, a fair value adjustment account, and you could put stock if you want to indicate that's where this account matches up with, $5,000, because whatever the value, the dollar amount balance is in that account will either be added if it's a debit, it's subtracted if it's a credit from our stock investment account. And then we will credit unrealized gain, net income, for the $5,000. Questions? Okay, so before we go on and do any other journal entries, let's see how all these transactions would be or impact our income statement and our balance sheet at December 31st. So first, let's look at the balance sheet. Let's assume this company is going to hold this stock long term, because they have to decide that at the balance sheet date. Do we plan on selling that, or do we plan on holding it long term? And they go, yeah, we think we'll hold it long term as of December 31st. So in their long-term investment section of their balance sheet, they will have stock investment, $50,000, plus the fair value adjustment account has a balance of $5,000 on the debit side, so it's added, and it will report then this stock investment at its fair market value. Sorry about the spacing, but you guys got the idea here. So the investment at fair market value, $55,000. So that's the amount they'll add in to all their other assets. No other part of the balance sheet is affected. How about the income statement? Well, there's actually two things from this year that are impacting our income statement. In the other revenue and expense area, the company will report dividend revenue. Remember, they received a $600 dividend. I believe that's what it was up here, yep. And unrealized gain of $5,000. So those two items are both going to increase net income. Questions? I'll give you a few seconds to jot that down, and then we'll take a look at what happens when we ultimately sell that. Then we'll have a few minutes and you guys can do a practice. I'll start getting that together now. Okay. That's a good one. Okay. So let's sell this. We thought we held it long term. We're not going to. August 1st of next year, sell the 1,000 IBM shares for $60 per share. So you're going to sell all of them. Now you're going to sell them for $60. So again, just like any other time you sell, determine the total amount you're going to receive when you sell these. Company A, 60,000. Subtract the original cost of the investment, 50,000, and the difference is your gain on sale, $10,000. So that's the computation. Now the journal entry. So on 8/1 of 21, what do you guys think? What do we debit? What do we credit? Anyone?
Cash, $60,000 debit.
Mhm.
Gain on sale, $10,000 credit.
Yes.
And stock investments, $50,000 credit.
You got it. Good. Just like any other time we sell an investment. Remove the investment at what you originally paid for it by crediting the stock investment account this time. Debit cash for the full selling price. And the difference, in this case, you sold it for more than you originally bought it at. So it'll be a gain. If the reverse was true, it would be a loss. Okay, so we just wanted to make sure we got through those. So you've seen some of these already when we did our debt investment. The major one that's different, I think, is you got a dividend instead of interest. Equity investment, so when the company owns stock and they don't have significant influence, we call it insignificant influence. So we have a few minutes left. Why don't we take 5 minutes? You guys go to page 556. Hold on. 556 in your book. QS 15-12. 15-12. Take 5 minutes or so. Work on that. We'll go over it quick and we'll be finished for today. Any questions right now? Okie dokie. I'll be right back.